The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hi, this is Esther Gulius, the tax lady from EG Tax, and this is our hour to talk taxes. And even though tax season is over, our job is to make sure that we get you ready for what was and what's coming, because what was, we have 3 years to fix, and we hope to keep you abreast of all the ever-changing tax scenes as well. And normally, we take phone-in calls, but then a couple times a year we do just email that we've gotten. So this is an email Saturday, so we're not going to take live phone-ins. We're just going to answer the emails. And, of course, I'm joined in studio with Tiffany Fabian. Hey, Tiff, how are you?
Hey, very, very, very good. Thank you for asking.
Nothing like springtime.
Ah, it's beautiful.
And
Beautiful.
Chris Fabian. Hey, Chris.
Hello, Esther.
Hello, Christopher. All right, we got all of our emails. And we just, what's so great about this is I love this because you get to see how taxes are not just a simple yes or no.
Correct.
It's a lot of maybe, right? Or if you do this, then this changes. So we're going to talk about our emails, and who's got our first email?
I've got Pete from Clarence. Tax lady, my 20-year-old daughter is a junior in college. She made $8,000 this year and claimed herself. Her 1098-T from school says her tuition was $8,000 and she got a scholarship grant of $2,000. Should I really upset the apple cart and amend this? What do you think, Pete?
Well,
Yes.
I mean, this is kind of classic, isn't it? I mean, this is a situation where you got 3 years to go back and fix a mistake. And it requires a little bit of gymnastics to do it, but the bottom line to the dad is a lot of money, right?
It is. Because a child under the age of 24 can't generally claim the refundable portion of the AOTC, American Opportunity Tax Credit, and so she's missing out on $1,500 that would go to dad, not to mention the non-refundable portion goes to eat up a tax bill, and she probably doesn't have much of a tax
Well, she
bill.
doesn't at
have any.
$8,000. She doesn't have any.
Right?
She doesn't have any
she has
tax
no
bill.
bill.
And so she's losing on the $500, he's the family credit, right?
Yep.
The New York State credit.
Yep.
So how much would Dad get, Chris?
Dad would get 5 plus 25 is 3 plus New York State. You're looking about $3,400 to $3,900.
Right. I mean,
Dad's
is that
losing.
worth it? I mean, you have to say to yourself, if I came up to you on the street, Pete, and said, give me $3,900, you would say, forget it, lady.
I know.
But we do this all the time. People let all this money sit at the IRS in state of New York, right?
Right.
Absolutely.
So I'd suggest, Pete, you open up your daughter's return, do an amended return, and if she did claim the AOTC, you're going to have to pay back $1,000. But then
Right.
you're going to do your return, and you're going to get back about $3,900. So
It's a
really a
no-brainer.
great thing.
Right.
Yeah,
and not to mention she wasn't entitled to the refundable $1,000 anyways if she would have. And that's what these kids come in, and I'll say kids because that's what they are, and they think they know everything. And they just do.
They don't know everything?
No.
I always
Shocker,
thought
shocker.
I thought
Breaking
once you're a
news, breaking
teenager,
news.
You know everything.
But if they were to read the instructions, there's on page 1 of the 8863, there's a little box. If you're under age 24 and the rules apply, check here. And 99% of the time, the rules apply, which
And
means
they never check here.
And,
Right.
and the IRS is not going to notify them and let them know that they did it wrong, and they're not going to let the parents know that they missed out on money.
Right.
You sort of have to take it upon
But
yourself.
it's a lot of money, too.
It's a lot of
It's
money.
not like it's $15. It's
Right.
like $2,900 the family's going to get.
Yep.
So, anyway, that's what we'd suggest. Good question.
Very,
good question
very
from
good
Pete.
question.
All right, what else we got?
Esther, I'm moving for a job this year to Florida, getting out of the Empire State. Working full-time in Florida, I know there used to be a credit for moving for a job. I was wondering if that credit still exists. I'm married with 2 children who reside in the home, and my wife will be finding a job when we get to Florida. But I've interviewed, I already have a job lined up, and they won't pay for my moving expenses.
And neither will the IRS.
Right.
Right?
That it was part of the tax reform. There used to be a moving credit if you moved for more than 50 miles, and no longer does that credit exist.
Now, it's still available on New York State, but only if you're moving into New York
and
State.
how many people are doing that?
Right.
Yeah.
Only the people that are crawling over the walls illegally, and they're not making any money.
So regrettably, the answer is no, Sam.
But he's moving to Florida, so it really won't matter anyways.
No state return.
I was going to say the job hunting expenses, which would be a New York State item. But for those people who are listening and do job hunting, that's still deductible on the New York return.
Right.
Unfortunately for him, it's not. He's going to Florida. He's paying no tax in Florida. But if you were to fly to Florida and you didn't get the job and you're still live in New York, that's still an expense on your New York return.
Right.
You know, your resume service, your paper, your driving around looking for jobs.
So let's clarify here. Federally, the moving expense is gone. Federally, the job hunting expense is gone. However, New York, if you are moving to New York, those expenses are deductible on the New York return. Likewise, if you are incurring any expenses for job hunting, you also can take that as an itemized deduction on New York. Right, Chris?
Right.
That's right.
So, no to Florida, but yes to New York.
Right. That's
All right. What else we got?
It's Esther. This is Alice. I'm thinking of moving into Tennyson Court for my senior years. They have independent living all the way up to and including long-term nursing care. The only holdup is the initial cost, since my plan is that I have to go into a nursing home and they have an on-site rate which does not go up. So is this deductible if I pay for this in advance? Alice.
Right.
And so the answer is yes, as an itemized deduction if you itemize under medical.
Okay, but a percentage of it is going to be deductible. So you'd have to find out from Tennyson Court what percentage is for nursing home, because they'll have all of the percentages.
It was around 49%
of the total
of
amount.
the down payment.
Right.
Right. And I mean, not to mention,
and they'll give you that information.
Right. They'll do it. It's a great facility. I know I have people there and they love it. You know, they're still independent living, and they come and go as they please. And
so I think the confusion lies is that she's paying it in advance, but we're a cash basis system, and the year you pay it is the year you can take the deduction, the percentage.
Well, again, you take that percentage, right? And then each year going forward, they still have extra expenses. So, and again, they usually give you a letter every year stating how much of it is attributable to nursing care.
Yeah.
And so that would be the medical portion.
And depending on her income, it's Alice, or if you're doing this, add up all your other medical.
Absolutely.
Icing on the cake.
Your dental, yep.
Yeah, no, I mean, and so you want to make sure that you do this wisely. Like for instance, for those of you listening that aren't going to Tennyson Court, load up all of your medical expenses in 1 year if you possibly can. If you got kids with braces, put the braces on a charge card, because once they're charged, it's deductible. And then, of course, this year in 2020, it's going to be 10% of your adjusted gross income.
Right. So if people missed it, they still obviously could amend their 2018 return.
Right.
And
again, I don't care what your friends told you over the backyard, you can still itemize. Right? Okay, I'm Esther Goulias, the tax lady from EG Tax. Our corporate headquarters at 1890 Colvin is open 9 to 5 to serve you. If you got any letters from the IRS or any questions, or you need your taxes done, we do taxes every day. I'm going to take a short break, and we'll be back on the other side. Hi, I'm Esther Gullius, the tax lady from EG Tax, and I'm joined in studio here with Tiffany Fabian, Christopher Fabian, and we are chewing up emails, which I think is very interesting because you get to go into depth. In depth, whereas when we're taking phone calls, we have to move from phone call to phone call. And of course, we'll be back next week with your live phone-in calls. And in the meantime, if you want to email us, you could be You could be one of our featured email people when we answer emails.
That's
right. So let's
right.
go back to the emails here.
I got Michelle. EG Tax. I have won over the year over $100,000 at the casino. That's good news. The bad news is that I lost over $130,000. I can still claim my losses, so I don't have to pay taxes. Am I correct, Michelle?
Well,
Go on.
there's good
Christopher.
news and bad news. Good news is the federal, you're correct. You can still take your losses to offset your winnings. And this also includes if maybe you only lost $80,000, but then you would have been able to claim your flights to Vegas or your driving to the casino, your bus trips, all your transportation costs due. The bad news now is New York State. I'll let Esther explain New York
Well,
State.
of course, that's if you have income over $1 million. As your income goes up, what they do is they start limiting the ability to use itemized deductions. So many people are unaware that if they have a large, let's say, a casino win of 500,000 on the lottery, New York State is going to limit the amount you can take as an itemized deduction if you have that kind of extra income. So that's something that lottery winners, I'm sure, are not aware of, that even though on the federal they let you put the income in, you are allowed your itemized deductions up to winnings as a miscellaneous itemized deduction. Not true on New York State. They limit the itemized deduction.
Right.
And let's
And-
not forget, under the new tax law, maybe somebody who doesn't win as much and her losses aren't so substantial, you can deduct transportation or flying or driving or, bus trip to wherever it is that you might gamble. So that's part of the new tax reform. And you were going to say something, Chris?
Right, I know. I've seen people's New York State itemized deductions start getting cut off at $250. So it is. It's a. New York State said, "Oh, look at what we're doing. We're giving you this great thing," but because we're going back to old
When you're saying
law,
the $250, you mean their income.
their
is
income is
$250. Right.
$250. So
and that's so people aren't aware of it. That federal allows dollar for dollar as an itemized deduction, right? Because it's not miscellaneous. It's not limited by 2%. The state of New York starts cutting it back. I had a gentleman that won last tax season $1.4 million at the casino.
Wow.
And on the federal, and they took out $16,000. So on the federal, he got back $16,000 refund. On the state, he owed $85,000 because they didn't allow the itemized deductions for his gambling. So gamblers have to really understand what they're doing when they walk into those casinos.
And I don't think
because it wasn't just one-time lottery; it was casino winning.
And I'm sure he didn't plan for that, which is really...
No, and he's a good, family man.
Yeah,
I mean,
yeah.
He was crying in my office, I'll tell you. Okay, what do we got next?
Jesse writes in, I am 64 years old, retired, and currently living on my investments, $5,000 a year, and Social Security of $24,000 until I have to start taking my required minimum distributions of my IRAs. I don't want to pay any tax. Is this a good plan?
No, he's got room for tax-free money, and so he should take advantage of that.
I mean, but right now he's tax-free.
He's tax-free.
Right? And he's got room
Yep.
to take more money out of his pension plan tax-free.
Yep.
But he has to find out what that limit is, because then he can, many people are always scrambling to put money in the Roth, because it comes out tax-free. There are lots of people under my voice right now that are not paying taxes. They have money in their IRA, and they could take it out tax-free if they knew how much, because your standard deduction might be $13,600 if you're single and you're over the age of 65. And if you don't have taxable income, you can take it out of your traditional IRA or your annuities, non-qualified annuities tax-free up to that level.
Yeah,
But you got to find out what that would be.
let's say he's single and he gets $12,000 as a standard, and if he's not over the age of 65, so he gets $12,000, so he's got room of another $7,000 or $8,000 to take out without paying taxes. And then of course if he's over the age of 59 and a half, and then 20,000 of it is tax free on the state, so he's not going to pay taxes on the federal or the state.
That's right. So, and that's where, I can't stress enough, this is a time of year that it's not like you would come in from cutting your grass and say, Martha, let's go do a tax plan. But I'm going to tell you, you should do a tax plan, because this is the time of year to facilitate some great moves so that you can maximize the amount of money you can take out tax-free or minimize the taxes that you're going to pay next year. This is when we really create those good moves to really save you some money.
Right.
Yep.
That's, and it's, this is how to find out how much money you can take out tax-free. But your life changes your taxes constantly. You get married, you have a child, maybe your child's too old to claim, you get divorced, you retire, a
die.
death of a spouse.
Right.
There's so many different.
I can't tell you how many stories I have during tax season where I wish people would have called me. One comes to mind. There was a client, she's about low 40s, and she went back to school to get her bachelor's. She doesn't have her bachelor's, and she took $35,000 out of a pension, and so the income was so high it disallowed her from getting the AOTC credit. And I was like, oh my God, if she would have only called me, if she would have only.
And instead of taking money out of her pension, had she rolled over that pension
Right.
to an IRA, she could have taken the money out without penalty.
Yeah.
Right?
Absolutely.
To go to college.
Yes,
I mean,
smart
these are
move.
little moves that people can make.
Right. That's exactly right.
Ugh,
I was so sad.
it does make you sad.
I've got Al, EG Tax Gang. Is this a silly question? My wife and I got divorced. Was it 2018 or 19? I don't know. Could you settle the dispute? The divorce papers are signed by the judge on 12/28/2018, but they were filed on January 8th, 2019. So we filed as married joint for 18. Was that correct? Again, my question, were we divorced in 18 or 19, and was it okay that we did joint? Al from Cheektowaga. And so,
Well, I would say we were always taught it goes by when the judge signs it. The
Right.
judge signed it in 2018, so your divorce is 2018,
Which means you should have not filed jointly.
right, but it also means if he was ordered to pay alimony, it's still a deduction for him.
That's true.
So, if you're paying, it doesn't say here, but say he pays $20,000 a year in alimony, that $20,000 going forward now is a deduction. So,
And she has to pay taxes
right,
on it.
if he's at the 22% bracket, that's a $4,000, $4,500 savings.
Right, but let's
what if they
let's
have
just be cautionary here. Make sure that it is considered. We have always been taught that when the judge signs the order, that's it. That's when the law happened. But just double check. But in the event that is correct, and I agree with Chris, you want to make sure you amend that return. And the good thing is you came under the wire for the deductibility of the alimony.
yeah. And then if they have children, she could do head of household, or whoever's the custodial parent, he could do head of household. And then the other person would do single. And so
Depending upon if they had kids and they
And
didn't
they
live
moved-
together.
Yep.
right.
Right?
Exactly. Yeah.
So that's one that I would double check to make sure, and if we are correct, you should amend that return.
I could
and really be happy if you are paying alimony.
I could almost see that going to tax court. I could see an auditor saying this,
Right.
an appeals person saying this,
Right.
and then
That's
it
why
just.
you got to know. That's why talking to your attorney is the best. You got to find out.
But the attorneys, how many divorce attorneys know tax law? We've seen how many.
But they would know when a law is a law.
Right. But I'm just saying, we see how many divorce decrees that are wrong, or they
Call
tell
your
them.
daughter. She's an attorney. Right? All right. That's true.
Yeah, it's true.
All right, what else we got here?
I,
And by the way, I'm Esther Golias, the tax lady from EG Tax. Our corporate office is open at 1890 Colvin, 9 to 5 Monday through Friday. We do make evening and Saturday appointments, so if you need special help. But in the meantime, if you have any questions, you can email us through our website at egtax.com. We're there all the time to help you.
Yeah.
All right, and we got another question.
I've got Jack. Esther, my brother and I want to flip a house, and if it goes well, we'll keep doing it. How do we report this on our taxes? Do we split everything and report it on our own return, or do we file a partnership?
They should file a partnership return,
A 1065.
right?
I would say yes. But you got to form the partnership.
Right.
That's where it can get tricky. But what the whole thing is, if it's one house and you're not going to do it again, it's a Schedule D transaction.
Right.
If you keep doing it, then it's a business.
Well,
and then
that sounds like what they're intending.
well,
they're
that's.
saying they're
But I'm
hoping.
just saying. That,
right. So I guess what you guys need to do is sit down and really solidify your intent. So if your intent is to keep doing this, because you then have to become an entity, a 1065 entity, and I would suggest they do a limited liability.
Right, so that people couldn't sue them and go after their own personal assets.
Right. This way, the only thing that's on the hook is the asset that they're purchasing to flip. And then once that, that entity is formed, then you're going to make sure that you keep track of what you paid for the house plus all the improvements. And of course, even though you can still sell it as a capital asset on a 1065.
Right. I know.
So-
I'm just saying, but you gotta.
But you do have to think about it.
I think
there are a
communication.
lot of people that do it very kind of loose.
Mm-hmm.
They don't form the partnership, but the correct way to do it would be to form the partnership.
Communication
I'm Esther
and
Golias, the
bookkeeping.
tax lady from EG Tax. Our phone number in studio. Oh no, we're not taking calls this week, but next week we'll be back in studio during the week. If you need us, 632-7886. We're going to break for the news. We'll be right back. Hi, I'm Esther Golias, the tax lady from EG Tax. I'm joined in studio here with Christopher Fabian, Tiffany Fabian. We're chewing up your emails today rather than taking live phone calls. But I will tell you during the week, if you're at a dinner party and people are saying, we know what's happening with tax law, and you're not sure, just go to egtax.com, ask the tax lady, email me, and I'll email you right back. Or during the week, you can call us at 632-7886. We're here all the time to help you. Our corporate headquarters is open 9 to 5, Monday through Friday, and we'll make special appointments if you can't make it during those hours. Okay?
Right.
Yeah, so if you're tomorrow for Mother's Day getting in a big family argument, should we have done this or do this? Just email us.
Yeah, right.
We'll take care of it. Look
That's
at
right.
on Mother's Day.
We're
we'll
still working on
We'll
Mother's
keep
Day.
Mama happy.
That's right. All right, let's see what we got for other emails here, Tiffany.
Michelle from Cheektowaga, EG Tax. So I didn't have health insurance last year. I only made $15,000 from unemployment, and I just landed a new job. I got the penalty. Is there nothing I can do? Well, there is.
There is something she should do.
Yeah. she
Again,
should amend a return.
it was interesting because a nephew of mine went and did TurboTax,
TT?
right? Because he didn't want to disturb Auntie Esther. Well, then they always call Auntie Esther when the answer isn't so good, right? So what can Michelle do?
She can do an exception to penalty on an 8965, and the cost of the health insurance is cost prohibitive. So she's going to fill out an exception where the cost of the health insurance was more than 8.12% of her adjusted gross income and all the household income, I should say. So she's going to do an exception to the penalty, and
By just doing that form.
by just doing
And
the
so that
8965.
eliminates the penalty. And then what happens to Michelle when she files her amended return?
She's going to not have to pay that penalty.
She'll
She's
get the
going to get a
penalty back.
refund,
Yep, that's right. That's
right? On the federal return.
Very exciting.
So-
and the individual mandate is gone for 2019.
So those of you that paid a penalty, I would challenge you, and you use TurboTax, I would challenge you to call EG Tax and see if we can't amend many, if not most, of those returns and get you the penalty back.
undeniably correct. What, Chris?
Because people don't understand, and they made themselves pay the penalty. But there's all these exceptions to penalty for the health insurance. And this year, of course, there is no penalty.
Right. And you don't even have to be a low-income person. Go on, Chris.
And, not to mention, she could have been on Medicaid all year, had free health insurance.
That's the sad part.
Right. But I can't tell you how many people I've seen. We're talking about the penalty. This person was unaffordable. But what about the people who are in the marketplace that they said, oh, I'm going to make $40,000 this year, so they got a subsidy. But when they did their tax return, they made $80,000. So they have to, they have to pay back that subsidy. I mean,
so when you're filling out these forms for the New York State of Health, don't be generous with yourself, thinking, "Oh, this is so great. I'm just going to say the low end of my income so I can get the subsidy." Make sure that you're realistic. Otherwise, what Chris is saying, you're going to have to pay it back.
You're going to have to pay. I mean, I've seen people pay up to $13,000 back because they I won't say they lied. They misinformed New York State of Health about their income. And it's an every year occurrence. How can you, if you know your income is going to be X amount of dollars every year, that's what the pattern is. Oh, this year it's only going to be Y. And it goes back up to X. Then it sounds like you're almost doing a fraud.
You have to be honest with
But
yourself.
here's the real important part is, if you don't have health insurance, you are sitting in New York State, which is like the mother of all. I mean, they have a program for everybody's health here. And there are all kinds of great
So take advantage of
benefits
them.
on the New York State of Health that could help you to get insurance. There is insurance that's $20 a month. There's Medicaid insurance. You'd be surprised the people that pay nothing for insurance. And of course, EG Tax has EG Health Connect, and we're very happy to help you if you have a question. Just give it, and there's no charge.
If you don't qualify for Medicaid, there's also the Essential Plan, which is $20 a month. And so there's other options, which is really good.
And, this is a good time to say, keep listening throughout the summer, because we're going to have our summer series again, where we're going to have special guests talk about different insurance, law, estate.
Estate planning, health insurance. I mean, there are all kinds of things that we like to get into in depth. But I will tell you, if you don't have health insurance,
property taxes,
before you walk around with no health insurance, at least give EG Tax a call so we can determine whether or not you qualify for insurance. Because many people, like for instance Michelle here, she qualified for free health insurance.
Yep.
And
Sometimes I think
so
not working and being poor is a good thing many times in this state, right?
Okay.
All right, what else we got?
I have Lou writes in, Esther, my mother put her house in my name right after my father passed in 2009. We sold the house so she can move to North Carolina. What do I need to know for my taxes?
Well, she needs to have a good conversation with Mom, doesn't he?
Yeah, because
And he has to figure out what the house was worth when Dad passed.
right, because this is a gift essentially, and so when you get a gift such as a house or anything, it goes back to the original basis. In this instance, it goes to Mom and Dad's original basis, and so they have to know everything that the house paid for. Of course, this is a half stepped up basis because half of it was inherited when Dad passed away in 2009. So they have to do their homework in two fronts. They have to find out what it was worth when Dad passed away in 2009 and what was the basis when
for
original.
Mom's half basis, right?
Yeah,
And you add it
absolutely.
together, and that's the adjusted basis. Now, what's really great, it
Conversations.
sounds like Mom is got good faculties, and maybe she can recall some of the expenses that she put into the house to make sure that that basis is correct. It's a real important thing if you're gifting a house to your children, that you have this conversation so your kids know what you paid for the house plus improvements, because upon if it's gifted to them, upon the sale of that house, they're going to have to pay the taxes on it.
Yeah, and then he asked what you do with his tax return. It goes on a Schedule D transaction, and so that's where it's placed, Lou. It goes on a Schedule D. But I think above all, Esther said conversations, and Chris said homework. finding out
Right.
about what it was worth. Chris?
Right. And the big thing, we see a lot of people throughout the years. Is it a life estate? Or was it a gift? And people don't know that answer.
Yep.
But that's a big difference.
It is a big difference.
Because say this was mom and dad's house and dad didn't pass and they gifted it, then it goes back to the original basis
of mom and dad.
Right. But if it was a life estate and it was in dad's name only and then it turned into yours, then it's the inherited, the full stepped up basis. There's so many things. But even in a life estate, for this if it was a life estate and mom moved, even though technically it's still mom's house, for tax purposes, it's the kid's house. And then it goes back to the original basis.
Right.
So it's a very convoluted thing. There's a lot of...
If mom is still in good health and you're going to sell the house, it might be better off for you to say, Mom, here's the house back.
Yeah.
Sell it. Mom won't pay any taxes depending upon what the gain is, because if she lived in it the last 5 years, it's going to be tax-free. Then her only problem is
The 5-year
the
look.
5-year look back. And
Right.
that's why I said if she's in good health.
Yep.
But then nobody knows. No one knows when the Grim Reaper is going to come at the front door.
Crystal ball.
There are a lot of things that you really have to take a look at. And if we all had a crystal ball, it would be perfect. But since we don't know, you can only go with what you know. And I will tell you, if this house stays in the kid's name, they're going to pay taxes.
Yep.
Okay?
I've got Kevin from East Aurora. EG tax. I just got a bill from the IRS stating that my estimated taxes were not paid. I have paid all of them, but they have not given me credit, I guess. What can I do? Kevin from East Aurora.
Okay, so he must have got the love letter that he probably owes money.
Right.
The first thing you got to do is make sure that you have all those canceled checks, right?
Right.
Yep.
And then he needs to make the call to the IRS in the state of New York. I don't know if New York, it just looks like it's just the IRS. And you basically say, I made the estimates, and they're going to ask for certain things, right?
They're going to ask for first they're going to verify who you are, but they're going to then say, what's the coding on the back of the checks? That's why you need the front and back of the check, because on the back is a special coding, and it tells the IRS where that money went to. So it could have gotten credited to a wrong person, or it could have got credited to the wrong year. It could have got maybe Kevin here is married and the wife wrote out the checks and put her social security number down and she's the secondary. The IRS doesn't look, believe it or not, they don't look under the spouse's name for estimated payments. So
They look under the primary.
only the primary.
So that's kind of that's something you need to do. Well, first of all, let's linger over estimates. And so Kevin, I think we answered your question, but let's talk about estimates. Estimated payments are prepayments for next year's liability that you can make in 4 installments. Now, you may think that the installment would be January, April, June, and September, but that's not correct. It's actually April, June, September, and January of the next year, which really confuses people because they say, but I made a January payment at the beginning of, let's say, the 2020 tax year or 2019 tax year, and why don't I include that? Because that's not the way the IRS does it. It's April, June, September, and January of the next year is included in the calendar year payments for estimates.
And I've seen, because and they want their money quarterly. They would like it evenly throughout the year. I've only seen a couple states out there that actually, when you're figuring out a penalty, what was your income this quarter? What was your income this quarter? So if you did make all your money in the third and fourth quarter, they'll adjust the penalties if your estimates were not the federal.
So you can hear Chris talking about the penalty. Because if you owe more than $1,000 to the federal government, or you haven't paid 100% of the previous year's liability, there's going to be a penalty. They don't like it. I've had clients that say, I just would rather just write them the $15,000 check at the end of the year. they're going to charge you a penalty.
Yeah.
They don't want you to owe them $15,000. They want you to prepay
Equal periodic
that liability,
payments.
and that's what is called an estimate.
And I would invite Kevin to call us at the office, and I could navigate with them because it's going to be really hard for him to get a hold of the IRS.
Well, that's true, and that's part of what we do
Yeah,
at EG
I
Tax.
do a conference
All right, I'm
call.
Esther Golias, the tax lady from EG Tax. This week, we're not taking live calls. We're just chewing up your emails. We're going to take a short break, and we'll be back on the other side with your emails. Hey, I'm Esther Golias, the tax lady. This is our last quarter hour of Ask the Tax Lady. If you have any questions and you want to be part of the show and you want your emails featured, just go to our website at egtax.com, Ask the Tax Lady, and maybe one of the other shows that we do, we will be asking your email question until next week, where we will take live phone calls. Now, I have Tiffany Fabian, Christopher and Fabian here in studio with me, and we have another email.
Sammy from Buffalo writes, Esther, my dad has paid for long-term care insurance for over 20 years, and last year he was in a nursing home. The cost was approximately $49,000. They gave him a check for $54,000. I think it was for living expenses. Is that possible? What should we do with the extra money that we received from Hartford? Should we record it as income on his return?
All right. What do you guys say?
Well, there's a couple things here. Because how long-term care does, they do it based upon per day. So if they did give you extra money, you have to record all his medical expenses on the Schedule A under medical. Then you back off the reimbursement. If there is extra, then it does go on line. Used to be line 21 of the miscellaneous.
Line it is. It's interesting. I saw the other day, somebody was referring about how to do something on taxes, or reading on a blog, and they referred to line 7 for the wages and line 20 because that's where our heads were. But the miscellaneous income line,
right, and it would still count. Whatever's left over would count as income. Now, I don't know if some of you even knew this. Even though a long-term care insurance is paying for the nursing home, there is still a bed tax being paid. Oh. You're still entitled
to the refund.
So if you know a parent, someone out there who's covered under long-term care, who's paying for their nursing home, get a copy of those invoices, because there will be a huge New York State refund coming.
6% of the nursing home expenses are for bed tax, which is
$7,000.
I know, but it's so interesting. Why would they make somebody pay a bed tax?
To give it back.
Would you think it has something to do with they know people won't get it back?
Right.
Yeah. And you think they're going to keep the money? And
Yeah.
they know that they should?
Yeah.
Do they split
Does
it
that
with the
seem
nursing
unethical?
home?
I
Yeah.
don't know.
Because if I was the owner of a nursing home, every family member would get a letter with the form. Please do this on your tax return. Please
That
do
is
this.
true. You know, we should contact nursing homes.
Oh,
That would be a really
that.
good thing, because we should be proactive and tell nursing homes, your patients may not know this. And, or even if we posted something.
Yep.
right,
and
but
then I also want to
digressed over
say
there.
no. I also want to say that there's a credit on New York State if you pay for long-term care nursing home payments. So every year, this gentleman for more than 20 years, he should have been, if he had a tax bill, receiving a credit on New York State for paying that long-term care.
Let's go back to the 6% bed tax. If you're a private pay patient at a New York State nursing home, the nursing home assesses a 6% bed tax on a $12,000 a month patient. Then that would be $720 a month that they're assessing you, times 12 that you're going to get a refund back. But only if you file the form to get the refund back. It's a refundable credit, and the credit is $258. There's a
Yep,
$258 that you'd have to fill out. So those of you that have been private pay on New York State, though, that bed tax is refundable, and multiple years you could get back.
Yeah, I was doing somebody's return this year, and they caused me to run a little bit late because somebody else did their return last year. and they didn't claim the New York 258. And so when she was done, she's like, "Oh my God, I feel like I just won the lottery. You just gave me $12,000. I never expected to
Of course,
get
they had
this."
to empty out their bank account to do it because of the nursing cost of the nursing home.
Yeah, but the
that
fact
is a
is
big
somebody missed
credit,
it last
and it's
year.
a big missed deduction.
Right. Right.
Okay, what do we got?
Let's see. We have
Tom from
Phil-
Tonawanda. Go on, Phil.
Phil writes in, I'm thinking of retiring due to a great incentive package. My boss told me that if I take it, they would bring me back as a consultant. Is that a big difference for tax purposes?
Yeah.
How is it that those companies do that? But anyway, yes, a consultant means you're self-employed. So the big tax that an employer has to pay is half of your FICA, and then, of course, you match the other half of the FICA. When you become self-employed, you pay both ends of the FICA, which is called self-employment tax.
Correct.
Right?
Right.
But you get to reduce the self-employment tax by expenses to be a consultant. So if you start working out of your home and you use your own home computer and you're using the internet at home, those end up being expenses. Maybe you go
Cell phone.
to the office a couple times a week to meet with the staff. That would be a deduction.
The mileage,
So your mileage there. So maybe you're getting some books, magazines. Maybe you just get a desk. All that would be deductible. So on your bottom line, you're going to pay the self-employment tax, and you can also put money into an SEP or maybe an IRA, depending on your age. So those are just some of the changes.
Or if you're getting Social Security and you're paying for Medicare, you can deduct that as an adjustment for health insurance paid for a self-employed person. So really good question, and you want to do your homework, and you might have to do estimated payments.
True. Okay, what else we got?
I've got Tom from Tonawanda. Tax crew, thank you for all your help. I was shocked when I found out that I owed $4,000 this year when I got my taxes finished. Right now, I'm saving up to pay that bill, and then I'll file my income tax return. My friends say I'm doing this wrong. I should have filed it first. Who is right? Your friend is right.
Your friends are right, Tom.
In this case,
because
the failure to file.
There's basically three things that the IRS gets you for if you owe money. First of all, there's a failure to file your tax return penalty. That's 5% per month until it gets to 25% on your liability. The second penalty is failure to pay, which is only 0.5%. Okay? And then the third thing is interest on the whole enchilada. So the big thing is, the big whammy is if you don't file your return. So what you want to do is get that return filed now, and it's a month after tax season. So you want to get that return filed now. So you're going to get stuck with that 5% penalty, but then that stops. As soon as they get that tax return, then they're going to charge you the 0.5%, which is much smaller than 5%, on the balance due. And hopefully you can work out a payment program with them. So you're going to really mitigate your penalty by getting that return filed quickly.
Yeah, and I hate to chime in and say this, but because you owe $4,000, a fresh set of eyes, just have somebody else look at it and make sure you're doing it right. Maybe you're getting charged for the penalty for not having health insurance. But get it filed, whatever you do, because we can amend it afterwards.
Yeah, and the truth is, there are people that have said, gee, I think I know I owe $10,000, but I think I'll wait till next week because I'm waiting for some paperwork. And I say, let's get this thing filed now with the extension. It was back when the tax season was open, because you want to make sure that you get that liability paid to stop that 5% failure to file penalty.
Yeah,
right?
Absolutely.
Okay, what else we got? A quickie. We should have
Maurice writes in.
Maurice.
I just got this nasty letter from the state saying they need proof for the withholding claimed on my tax return. Don't they have the payroll records? Why should I have to prove anything?
Yeah, and so the New York State wants to see proof of your withholdings, and so you have to get it in. You have to provide them with proof of your withholdings on your 1099-Rs, your W-2s, not your Social Security, but your 1099s, your W-2s. And so you just have to get that in, and then they have 6 months from that date, once you provide it to them, to furnish your refund after they verify the information that you provided. And I've done some legwork, and I've called New York State, and I asked them why they're doing this. They said they're doing this to protect your identity. And so delay your money. They keep it longer. I've even seen them now going one step further, saying, "Oh, thank you for your W-2s. Now we need individual letters from your employers stating that that is correct." I mean, so every time they delay it is another 90 days till they have to.
So the bottom line is, but you have to be diligent. So when they send you these letters and you say, let them look it up, they're not going to look it up. They did get the New York 45s. You know,
Right.
but they're not going to look it up. The burden of proof is on your shoulders to prove it. That's the way the tax law is written, so that it's up to you to prove what you put on your tax return. So if you don't answer that correspondence, quite frankly, you will not get your refund.
Yeah, I actually had a client that got a letter last year, and they didn't do anything.
Right.
They're still waiting for the refund. I said, you're never going to get it.
Right.
You need to come in, and hopefully, I believe I saw them at the end of this month. We're going to call New York State and get everything faxed over and get it taken care of, so he'll finally get his refund.
I mean, think about how many people in this state that are getting letters that are not corresponding. They just are not detailed people. And guess who gets to keep your money? So if that's you, then change your W-4 at work so that you don't get a big refund.
Excellent point.
Because this way, let you pay them rather than they pay you. Because if you're not going to answer their correspondence, they get the money through default.
That's an excellent point.
All right. Okay. Well, I think we beat these emails to death. I'm Esther Gullius, the tax lady from EG Tax. Our branch offices are closed this time of year. We're still open for business. Our corporate headquarters at 1890 Colvin is open 9 to 5 Monday through Friday. I'd like to thank Tiffany Fabian, Christopher Fabian from EG Tax. And, of course, if you need us, you can go to our website at egtax.com, ask the tax lady, and we're there to help you. Until next week, where we'll answer your calls live in studio again. I'm Esther Gullius, Christopher Fabian, Tiffany Fabian. Have a great week. Bye-bye.